Well, hello, everybody. It's Tom Sheridan and Chris Darbyshire from 7IM, here to talk about what's new in 2014, what are we doing about it, and a little bit of a reflection of what happened last year. Why don't we just start with last year? A stonking year for markets.
Amazing year.
Where were we 12 months ago, just to bring people up to date?
12 months ago, we were still very worried about the Eurozone, still very worried about economic growth and whether it would really get off the ground and whether this new normal was here to stay of lower growth. And we had, German elections, we had Berlusconi being a problem in Italy, so there was quite a few things out there that perhaps in retrospect we shouldn't have been so concerned about.
It seemed to me that the newspapers every month had something new that was going to cause the world to come to an end. You've just mentioned a couple of them, and there were several more as well. Somehow, with all those things to worry about, none of them really materialized.
No, and economies have a way of getting through the worst and finding growth where you think it's hard to find. And I think we saw a bit of natural healing going on last year.
And we got to that point at the end of Q3, and at the beginning of Q4 of last year, we had one particular concern, didn't we?
So tapering was the major concern for the markets, really for the second half of the year. What effect would it have on interest rates? What effect would it have on other economies? So we eventually had tapering in December, and the markets actually went up, which we thought was a very good sign that tapering is really not the big concern that people thought it was.
Unbelievable, wasn't it? The column inches dedicated to that one were astounding, and lo and behold, the world didn't melt. But the good time that we had last year in investment performance, is it over now, is the question that people are asking.
We don't think it is. We think that the good news carries on, but it transitions from an environment of healing to an environment of where's the economic growth. So we begin to get back to economic fundamentals. Yes, monetary policy is still very loose and still very helpful to companies and people. Interest rates still very low. But actually it becomes more and more about this economy is growing, why is it growing, how fast will it grow, rather than where's the disappointment going to come from.
So if we've had the relief rally, if I could call it that, and we need growth to go from here, for markets to go from here, I would guess we could break growth down into various components of personal consumption, corporate investment, government expenditure, trade activity. Why don't we go through our thoughts on those various components of will growth happen, won't it happen?
Well, taking the first of those, personal consumption, what's important there is the ability for people to earn more money, to get back into work if they're unemployed, and to make more money from the job if they're currently employed. And the unemployment rates are looking pretty good in the US and the UK. They're moving in the right direction, moving quite rapidly. Europe is beginning to come through. It's a different phase in the cycle. Consumer confidence is picking up. So all in all, it's still not where you would want it to be, but it's on the right trajectory.
So personal consumption, particularly in the West, in the US and the UK, is the majority of GDP, isn't it?
About 2/3.
And so what's not only the actual, but what's the sentiment looking like when it comes to consumer spending?
It's beginning to look pretty good. It's still coming from a low base, but all the indicators are pointing up.
So what order of magnitude is okay versus whatever we might call normal?
I think we'll be normal in the US in 2014, and we'll be very close to it in the UK.
That's a lot better than we were 12 months ago in terms of outlook for economic activity. Now, the thought has been if employment returned to more traditional levels or unemployment returned to more traditional levels, we then take up the slack in the labor market, you start to have a little bit of wage pressure, you start to get away from the deflationary fears, and companies which have been sitting on massive amounts of cash might just begin to spend it a little bit. And what we talked about the last time was as and when we think that moment arrives, we then really do have an engine of growth.
That's right. That's another big part of the economy. Company equipment is extremely old and getting older because over the last few years companies have not spent. They've hoarded their money. If companies see that the consumer is ready to spend again, that will be an incentive to get out there, make some investment, buy some new equipment, and that's a big part of the growth picture that has been missing.
That's a nice thought. Are we seeing any evidence that it's happening?
We're seeing good leading indicators. I'd say we're not quite seeing the spending coming through yet, but we're seeing enough positive indicators that we're fairly confident it will come through.
Of course, by the time it's happened, and you can see it in the economic numbers, the market reaction has come and gone already.
I think that's absolutely right, and you'll be looking back in time then.
How about the consumer durables portion of that equation? So you have company capital expenditure, but you also have homes that they have cars and dishwashers.
And all these goods, have not been replaced in a long time. They're getting old as well, and so wear and tear is going to become a problem for the consumer as well. So consumer spending, will come back at some point. And again, the indicators there are all pointing in the right direction. So we're quite, optimistic about that.
So in addition to the favorable moves that we saw in housing during 2013, we start to see a little hope in terms of consumer spending and investment expenditure on behalf of companies. That begins to paint a picture where you could understand where growth would come from. Governments are also a big chunk of GDP. What's going on the government front?
So governments have really been a drag on GDP growth over the last few years. And that is about to change. It's not that governments are suddenly going to go into spending mode, but they are going to stop the reduction of spending. And that alone means that you haven't got this drag on the economy that you had last year. So the US actually next year should record something like a normal or even maybe slightly above normal growth rate. Partly coming from the things we've talked about, consumers spending more, companies investing more, but also the government just equalising its expenditure year on year.
So government expenditure, the austerity programs rolling off, what does that do for global trade? We have, with the consumer, the corporate, and the government side of the equation, what happens to corporate trade? And importantly, who does it impact?
So it has a positive effect on global trade, and one of the sort of components of growth that is already actually ticked up are, trade data such as, freight rates, the amount of freight being shipped around the world, both air freight and shipping. All those data points are now already pointing up. So we have another leading indicator that makes us positive about 2014.
And I remember back in 2007, the freight activity declining was one of the reasons that we actually got quite cautious in 2007. It has, for us, been a good leading indicator. So that's an extraordinarily rosy scenario. You're basically telling me that the consumer's picture looks okay, that the corporate expenditure looks okay, that government austerity is on the wane, and trade is picking up. Was that the reason, anticipation of all that, was that the reason that we had a good year last year? And what's the inference for markets, not economies, in 2014, or have we seen it all already in markets?
Well, I think all of those positives maybe kicked in towards the last quarter of last year. I think most of last year was still about reduction of risk, and not the risks not materialising, and also the massive, boost from very, very low interest rates. I think a little bit of the positive data has come into the markets maybe in the last quarter, but there's still a long way to go. Because what we're coming into now is normal. It's normal to think about freight, normal to think about company expenditure. So all of these concerns, these are the fundamentals that suggest we're in a normal part of the cycle. The cycle is back. And for us, that's what 2014 is all about. It's about transitioning from monetary policy, from the negatives, to focusing on the positives and getting that positive news flow coming through.
Let's take that conversation And let's turn it a little bit toward asset classes and regions of the world. Which would you like to take first?
Well, if we start with the US, where we've gone from being slightly underweight, our neutral allocation, we've gone back up to neutral. It was quite highly valued in Q3, and we were a bit concerned that there were better regions offering more value. But we've reversed that decision. I think we still think the story in the US is accelerating, that we shouldn't be worried too much about valuations yet.
Well, that's actually taken a lot of the space in the press these days. The Case-Shiller seems to have grabbed the new spotlight in the media, and because Case-Shiller says that actually U.S. equities are expensive, now everybody's worried about, oh, maybe it's top of the market. Thoughts?
So the Case-Shiller is one type of valuation which takes the 10-year earnings over the last 10 years and says that's a normal cycle. If that's a normal cycle, then at the moment we look rather expensive on U.S. equities.
So it takes today's price over the last 10 years of earnings,
Correct.
Average.
And we would argue that the earnings over the last 10 years, in the middle of that 10-year period, was a very, very serious crash, credit crunch, that means that it's just not a normal period. So we'd like to see something a bit more forward-looking than that.
And on other measures of valuations, what do U.S. equities look like?
They look average to maybe slightly above average. At this point in the cycle, when the economy is beginning to really get going, I think you'd expect valuations to be above average. So we should not be disconcerted by that.
So we've talked a little bit, you and I, about the fact when you get growth, you do get an expansion in multiples. That looks like where we are now. Huh?
Agreed. Yeah.
Okay. So U.S. equities, still looking okay. You're on the equities. Why don't we continue with the equity theme and talk about equities in the UK, in Europe, in Japan, and emerging markets?
So UK equities, smaller companies in the UK have done very well indeed, and they are also priced actually significantly higher than average, and there's no debate about that. So we've pulled back on those. We're underweight. We've taken that money and put it into smaller European companies where we think the rebound is still very much to come through in prices. We like European equities generally. Still a lot of underperformance there over the last few years versus the US, and still a lot of growth and recovery to come through. So that seems to us to be a good valuation opportunity, and you're beginning to see it come through in prices.
A couple of years ago, we had the emerging markets providing the growth in the world. And China in particular spent a lot of money on infrastructure projects and did a lot to keep the global economy afloat during a very awkward moment in time. Are we now at a point where it's Western consumption that's probably going to go back and drive emerging market manufacturing?
I think that's exactly right. And emerging market prices have really not done well over the last couple of years. So there's a lot of skepticism out there about whether EM can deliver earnings growth, whether the EM governments have got the right kind of governance, management of the economy in place, and a lot of negative sentiment. So we're actually significantly overweight emerging markets. We think it's definitely going to be a source of significant growth economically, and therefore there will be good earnings growth, perhaps not as good as some moments in the past, but I'd be very happy to pay a low multiple for that earnings growth.
So the unloved markets are arguably emerging markets in Europe now, and we're still got an overweight position in both of those. Is that right?
That's correct.
Okay. In terms of the Japan situation, massive roll of the dice with Abenomics over there. How's it looking?
It's looking good so far. It's beginning to come through in the macroeconomic data. So we're beginning to see the Japanese economy moving in the right direction. Perhaps not as fast or as far as Abenomics suggest it would, but the fact that this is happening at all is really very significant, and it's got people believing that there is something in Abenomics. Also, the Bank of Japan has a few tricks up its sleeve still. So we think the factors that were in place last year that made Japan really do well for investors, a few of those are still there and they are still significant.
So have they broken the deflationary cycle of the last couple of decades?
I think they haven't quite. They haven't proved it beyond doubt, but it's more than a 50% probability.
Okay. And the other thing we were worried about was China. You know, the new leadership coming in 18 months ago or so, hard landing as they implement all the difficult policies right away, as any new government would like to do. What's the Chinese situation looking like?
Still some concerns about a hard landing out there, and China still has the problems with bad debts and so on, and overbuilding in the economy. But on the other hand, it's settled down into a lower growth pattern, but it does seem to have settled. The new government coming in really has said some very positive things about moving more towards the kind of free market economy that we are used to. So I think that the Chinese picture is delicately balanced. If the nasty factors come back, you could see China and probably emerging markets fall further. At the moment, we think it's a risk worth taking.
Okay, so acknowledging that we do have a number of risks still out there, long story short, we still like equities.
I think at times like this, with the economies turning in the developed world and the global economy beginning to grow again, you've got to back companies to make more profits.
Fixed income. The message that we've gotten from the central banks is that the tapering of QE does not mean the end of low interest rates. And they seem to have been successful in marketing that message. So if we have a continued period, 2014 into 2015, of lower rates, what's your view on fixed income?
It's difficult to see a lot of return in fixed income. There are still pockets, high yield, emerging market bonds beginning to look interesting again if you can stomach the risk. But on the whole, the big asset classes, government bonds, corporate bonds, they are still vulnerable. So
we have been, during the fourth quarter of 2013, very short on duration. Are we holding with that view?
We're still very short on duration. We continue to move in that direction as well, of shortening the duration risk.
Okay, so some point in time over the next 12, 18 months, we may come to the view that rates have gotten back to normal levels, and as and when that happens, we then may look to add a more normal fixed income component to the portfolios. But at the moment, very short of duration, underweight the asset class, bit of credit exposure and a bit of currency exposure?
Absolutely right.
On the alternatives, what do we think of commodities? What do we think of property? What do we think of private equity? What do we think of the non-equity fixed income portions of the portfolio?
So we're still not keen on commodities. We've had a zero weight now for 9 months, and that continues. We don't see how the cycle really changes significantly in the short term to make commodities very much in demand again. We also have the new shale oil reserves coming through from the US, which is a big factor. In terms of property, we're beginning to like UK property, so we're looking at expanding our investments there. We like private equity a lot. It was a good performer for us last year. We had a very overweight position, did very well for us, and there's still a long way to go in normalisation of private equity valuations. And that leaves us with gold, which we're still bears on. Yep. Gold, really believers there, and again, that's worked well for us over the last 9 months.
So, as a CIO, you've actually had a very good year in 2013. We have very clear views on what we think our positioning ought to be, and in fact is, in terms of equities, fixed income, and the geographic allocation. The one swing factor that we always go back to at the end of these conversations is, and what's the currency story?
So we recently unhedged our US dollar holdings, so we've been anticipating the pound strengthening. When it got to 165, we took those hedges off. So we're now anticipating a period of dollar strengthening and pound weakening. That's our biggest currency exposure.
Yep.
We are, again, bearish on the euro versus the pound, so we have a large hedge in place there, as we think the ECB is more likely to loosen monetary policy, whereas the Bank of England more likely to tighten.
Okay. So again, very clear views on where we want our hedges and where we don't. The last question before we call it to a close, well, what can go wrong? Because you've just painted a fairly rosy scenario for portfolio construction.
That's right. I mean, we've really got more of the same from last year, but for different reasons. What can go wrong? For me, the two big factors are really inflation going up too much or coming down too much. So it's inflation and deflation are the issues that I think we have to worry about. While inflation stays in the sort of Goldilocks zone that it's in at the moment, neither too hot, neither too cold, then I think the central banks are going to be able to continue to stimulate wherever they can through low interest rates, and that provides a lot of support. I'm a bit worried that if inflation veers off one way or the other, you're going to have a change in policy required, and no one knows what that might be, and I think that would give the market some pause for thought.
So if inflation is the big worry, I guess that would translate into interest rates.
Fear of interest rates going up is really what tapering was all about last year, and I think that fear is still out there. So that is something we're really concerned about. However, actually, inflation at the moment is falling and is below expectations, and while that trend continues, there's a possibility it might become deflation, and then the central banks really have to put their thinking caps back on and come up with new policies to try and stave it off.
Well, Chris, thank you very much for your thoughts. Thank you for a good 2013. The clarity of views in 2014 going ahead, and let's see if we can keep an eye on it and keep ourselves on the right side of things. Thank you very much, and thank you very much for your support.